It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader today. This video newsletter is brought to you by PortfolioCrafter.com.
Welcome to this edition of the TradingTips.com video newsletter. In this episode, we'll be looking at a hot topic, the presidential cycle. Is this a simple tool to beat the market, or is it just nonsense? Let's continue. U.S. presidents are elected to 4-year terms, and this creates a 4-year presidential cycle. The theory here is that stocks perform best in years 3 and 4 of the cycle, and that they underperform in years 1 and 2. If true, then investors could profit by using this knowledge by buying during the underperforming years, and then selling during the outperforming years. But is this for real? First, let's answer why it could be true. The theory is that in years 3 and 4 of a presidential cycle, the president is trying to get reelected, and thus he does everything he can to juice the economy. Then in years 1 and 2 of the next term, whether it is the president's second term or a new president's first term, there is a hangover effect. This goes along with Austrian business cycle theory, with its booms and busts, and has a lot to do with the Federal Reserve. Why would a Fed chairman want to ensure a president's reelection? To ensure his reappointment, of course. This could actually be one of the causes of the boom and bust business cycle. Dating back to 1900, stocks have averaged 8.81% gains during the first 2 years of a president's term, and 16.07% during years 3 and 4. This is a difference of 82.4%. It seems pretty far-fetched to think this is entirely coincidental. Nevertheless, there are critics of the presidential cycle theory that say the sample size is too small. There haven't been enough presidential terms in order to determine if this cycle effect is statistically significant. A second criticism is that the president isn't powerful enough to affect stock prices. But the president, along with the Fed chairman, can do a lot to affect nominal prices by juicing the economy and devaluing the dollar. Critics say the Fed is not incentivized to work on the president's behalf. But as already stated, the Fed chairman wants to be reappointed, and in recent history, Democrats have had no problems reappointing Fed chairmen who can be cooperative. Both Alan Greenspan and Ben Bernanke were initially appointed by Republicans, but then reappointed by Democrats. A fourth criticism is that all 4 years show average gains, but gains in years 3 and 4 are bigger than in years 1 and 2. And finally, a legitimate criticism is that reelection is not taken into account. For instance, George W. Bush had no incentive to juice the economy during his final 2 years. And it showed. Stocks were down 57% during this time, greatly throwing off these averages and making the presidential cycle look less real than it is. Speaking of the Bush administration, let's look at years 3 and 4 of his first term, where he was trying to get reelected, compared to years 1 and 2 of his second term, the hangover. During years 3 and 4, stocks were up 37.7%. During years 1 and 2, they were up, but only 17%. This is a difference of 54.9%. Here's a chart illustrating these differences. On the left side, Bush has an incentive to juice the economy to help ensure his reelection. On the right side, he did not. For a more in-depth look, here's a comparison of George Herbert Walker Bush, George W. Bush's father, and Bill Clinton. In the final 2 years of Bush 1's first and only term, stocks were up 31.9%. as Bush allegedly tried to juice the economy. Bush was not reelected. And then the first 2 years of Clinton's first term were the hangover. Stocks were up only 5.4%. Then, however, in years 3 and 4 of Clinton's first term, stocks were up 61.3%. The cycle then breaks down, though, because the next 2 years, years 1 and 2 of Clinton's second term, saw stocks up 65.9%. Nevertheless, the average for years 1 and 2 for both presidents was plus 35.65%, while the average for years 3 and 4 was 46.6%, a not significant difference of 30.7%. Here's a brief look at the past 2 years, years 2 and 3 of President Obama's term. Now, in year 4, stocks have been doing well. But what does this mean for the rest of 2012 and then 2013? We hope you've enjoyed this TradingTips.com video newsletter. Thanks for watching and good trading.
This video newsletter has been brought to you by Portfolio Crafter. Manny Backus designed Portfolio Crafter to be one of the easiest trading systems available on the web today. But don't take our word for it. Visit www.portfoliocrafter.com and access the free special report. It will show you how you can place profit-rich stock trades in just 15 minutes a week. Read the free report, and you'll understand how the easy money's made in the markets. To access the free report, visit PortfolioCrafter.com. Portfolio Crafter, another market-beating investment service from WealthPire. Take control of your financial destiny. View more Trading Tips videos. Visit TradingTips.com. Sign up for our free video newsletters and become a successful trader today.